Hi, everyone. Welcome to our webinar this month. It is on financial tips for young professionals. So we'll get right into it. So I'm Jared Bilodeau. I'm an associate wealth advisor here at 12 Points. I have a master's in financial planning, and I work on the individual side, financial planning, and on the 401k side. And I'm here with my colleague, Greg.
Hello, everyone. How are you all doing today? Looking forward to giving you some good tips for the millennials out there. As you can see over there, I'm Greg. I help run our 401k operations here and act as an associate wealth advisor, educating employees on saving in their retirement plans and being financially well.
All right.
So I'll pass it back off to Jared to talk about some fun stuff, debt.
Yeah, not a fun topic, but it's something that everyone should know about. So we get this question a lot. What does it take to pay off student loans and other debt? And people want to know this in terms of dealing with their debt and then balancing that and saving at the same time. And we'll get into saving right after this. So by far the most common high interest debt that people have is credit card debt. It can be anywhere between 15 to 20% interest that you're paying on that debt. So you want to make sure to be paying that off in full monthly. Some people will think that it's fine to do the minimum balance due, but as we'll see in our compounding example a little later on, when you have interest either in debt or in saving, that interest rate over time has a big impact.
And as you mentioned before, Jared, credit cards, they can be a great tool actually, but you definitely want to make those payments because you can build your credit score with them, but you can also hurt it.
Exactly. Most likely later on you're going to be looking at car loan or mortgage, and all the banks are going to be looking at your credit score. So you want to build that up by paying things off on a timely manner. Not having too much in the way of credit. Like if you have 10, 15 credit cards, that's not looked at in a good way too. And then we'll touch on the 3 large credit bureaus that they'll be looking at later on. But the main thing is paying down debt, you want to do your high interest debt first. So usually that's credit cards. And then it can be student loans. I know personally I had student loans ranging from anywhere between 4 and 8%. So I looked at refinancing and consolidating those when I got out of school. And I looked at all the tools online like SoFi, local banks. I ended up going with a bank that I use mainly now is First Republic Bank. And they're a little bit more strict in what they're looking for. You had to have at least $60,000 in student loan debt, which I unfortunately had. But I was able to get a good rate with them. I have a rate now that's around 3% as opposed to the 4 and 8% loans that I had before that.
And you're able to consolidate them nice and organized into one place. But you should also be careful for that, right?
Exactly. Yep. Just because you can consolidate it into one loan doesn't mean you should for all of them. Like I had a friend who had loans similarly ranging from 3% all the way up to 10%. And he was able to get as low as rate as 4%, and he was going to consolidate all of his loans into that. But I told him that it didn't really make sense to do the 3% loan because you're tacking on an extra 1%. You can still when you consolidate, you don't have to do all the loans. You can just do the ones you want. And that you might want to keep your government loans too for the loan forgiveness. But that gets into a whole nother topic that we can spend another half hour to an hour on, so I won't get into that. But when it comes to all your debt, credit card loans, your credit cards, your student loans, your car loans, and your mortgages, the key to paying it down is looking at the interest rate and paying that down first. And then on credit cards specifically, make sure you pay off that balance in full every month because credit card debt can be your real burden if you let it get out of control. Now we'll get into savings. And on the mortgage, Dave last month went over mortgages and buying a house and all that, and that'd be a good webinar to check out if you're interested in that.
All right, Jared pleasured us with the fun debt talk, so we'll move on to saving up. So a lot of the problem with millennials comes with balancing that debt and savings. Many millennials, as Jared spoke of, have that high student loan debt, maybe some credit card debt, maybe they have a car as well. So they don't really see how it's possible for them to save at the same time as paying that debt. Well, we're here to tell you that it might be difficult, but there is a way, and you really want to make sure you find a way, because the earlier you start, the better. I know we have a lot of time till we retire or think about other things in life. Seems years and years away, which it is, but all that time is on your side, and that's really gonna benefit you. So you take a look at the picture graph over on the right-hand side. It's a very powerful example showing how starting early is so beneficial to you. So we have Joe and Phil here. They're both going to contribute $5,000 per year, and they're both going to get a rate of return of 8%. So it's a common example across the board. However, you have Phil, who he has the mindset that he has years till retirement or the future. So he's not too worried about saving up right now. He's just going to focus on paying the debt, or maybe buying fun things, buying cars. While Joe, he gets it. He knows that if he starts saving now, his money is going to compound greatly over the years. So he knows that the earlier the better. So Joe, let's say he's 23 years old, just entered the workforce. He's going to start saving right away. This example is $5,000 per year. I mean, I'm not saying anyone has to reach that level right away, but start with something. But in this example, it's $5,000. So Joe saves from years 1 through 10, so only for 10 years. While Phil, he's going to wait 10 years, and now he probably has a family, a lot of other burden on him, and now he decides, I'm getting a little bit closer here to retirement, and I should probably start saving. So he's going to go on and save from years 11 to 50, while Joe stops only after 10 years. And if you look at year 50, look who still has more money at the end of the day, and that's Joe. And he only saved for a quarter of the time as Phil, but he started earlier, and that's really the key. I mean, you're going to get a rate of return in the market that's a little unsure. You're not sure what that's going to be, but that the compounding, no matter what it is going to be the biggest piece of it. So starting early is extremely important. Now, some ways to do that, as you see on the left-hand side, 401k and IRA. The 401k is going to be a workplace sponsored plan. So if you have a job that has one, that's great. You should feel happy that you have that benefit, because oftentimes, as you see there, employer matching is going to come along with that 401k. So the employer matching is huge. That's free money in your pocket. So a lot of employers of your contributions up to 3%. So if you're going to take 3% out of your paycheck, which that's not really that much, and I think most people can make it work to hit that. And we'll talk about budgeting and how you can cut expenses to hit these numbers. But you're going to put 100% or 3%, of your paycheck into the 401k. Your employer is going to match that 3%, 100%. So that's 100% rate of return right off the bat, and that's free money in your pocket. So I advise, if you have that match, it might even be more than 3%, and then you really have a great benefit at your workplace. Do your best to meet that match. I mean, it could even be up in the 5 and 6% range. I know that might be tough for some millennials with all the debt they're thinking about, but as you see in that example, just keep looking back over at Joe. He made out pretty well by starting early. So now you have to balance that debt, as Jared spoke about the debt. So if you have that high credit card debt and you absolutely can't contribute to your 401k and reach the match before you pay that off, then yeah, absolutely pay off that credit card debt, because you can get into a lot of issues down the road. and, by hurting your credit score, but also the interest rate is extremely high, often 10 to 15%. However, on those student loans, you're often able to refinance them, as Jared mentioned as well, to a very favorable rate. So if your student loans are around 4%, if you think about it this way, the 401k, you're putting in 3% of your own money. Your employer right off the bat, in my example, is matching 100% of that. So you automatically have a 3% return. The student loan, 100% return, I'm sorry. So the student loan has that 4% rate, but you're already getting 3% from your employer, plus market growth, which you maybe conservatively expect 4 to 6% per year. You're over that interest rate of your student loan, so that's a positive net gain. And that's how you're really going to grow your wealth over time, opposed to, disregarding the 401k until you pay off all your debt and not even worrying about, saving for retirement at this point. So that's what it's hard to see and it's hard to think about when you have all that debt, but it's very important and can be very beneficial. Now, some people just can't deal with the debt, and if you're one of those people and you can't sleep at night knowing you have all that debt, even with what we're telling you, how you're going to make out better getting that 401k match, then by all means, pay off all your debt first. It's what makes you most comfortable at the end of the day, but usually the most advisable thing is if you have that low interest rate debt with an employer match is to definitely, make use of that match. And along with the 401k, as you see there, is tax advantages as well. So your money, if you choose to do so, is pre-tax. So that 3% is gonna affect your take-home pay, a little bit less than that. So it's really beneficial all around. It's a very powerful tool, and we can't stress enough to start early, as far away as retirement seems.
And that money is not taxed until you take it out in retirement as well. So if you had money in, say, a brokerage account that's taxable, you pay what's called capital gains tax, and that could be to 20%. And that's when you sell a stock or bond or mutual fund, whatever it is. But when you put it into a tax advantage plan like a 401k or an IRA, which Greg will touch on in a minute, it's not taxed until you take it out in retirement. And it'll be most likely lower because in retirement, typically you have a lower tax bracket.
However, tax rates are very low right now, so it's something to consider between Roth, which I'll speak about with the IRAs, and pre-tax. But that's something we're happy to help you out with if you're having trouble making that decision. But yeah, as Jared mentioned, the tax advantages are huge. The money's going to compound tax-free in that plan, in the 401k. So you're paying no tax, and that's what makes the compounding even greater in something like a 401k, opposed to just saving in a savings account or a brokerage account, as Jared mentioned. So it's huge. So, I mean, especially if you have that match, even if you don't have the match, the tax advantages alone are very beneficial to start saving. So now, if you don't have a 401k offered to you at your workplace, which, it's very possible, there's another option for you to still, get some savings going, and that's the IRA, which is an individual retirement account. So the IRA will still have some favorable tax advantages, which make it an attractive tool. You're not going to be getting an employer match, unfortunately, because it's your own account. It's an individual account. But it's still a great way it's all about getting in that habit of saving. So, Joe and Phil are doing $5,000. That might be a little unrealistic, but even if you're doing $20 a month and you slowly escalate that and really just get into the habit of saving for your future, because Joe will tell you it'll pay off. And yeah, that's really it. So I think now we'll move on to budgeting, which Jared's going to touch on. And this is kind of the key, where if you don't think you have enough to save up with all that debt, there is a way, and Jared's going to help you walk through that.
Budgeting, the B word. A lot of people don't even like to talk about it, but it's basically looking at your expenses, looking at your income, what you're bringing in, and weighing the cash flow, and then picking how much you want to spend in every area, whether it be food, drinks, car insurance, anything. So the first step in that is recording your expenses. So there's a number of ways to do this. You can do Excel, which both Greg and I use, mainly because we use Excel all day, every day, so we're very fluent in it. But there's more user-friendly ones like Mint, mint.com, and they also have an app. There's a budget tracker, every dollar. There's numerous tools, so you can pick the one that looks good and works with what you want it to do. But most of them do the same thing. They take your credit card, they take your savings in your checking account, and they sync up with them, so they track what you're spending on a daily basis, and then you can set budget goals. Like say you wanted to spend $300 a month for food, it'll track how much you're spending, how close you are to that, and what you can spend without going over it for that month. So that's good. It's good to see it on paper, and when we get to step 3, I'll mention that more. But the next step is create a budget from your expenses. So look at what you're spending now. Pick how much you want to spend, usually on a monthly basis makes the most sense, and then track those with whatever tool you're using. And then you can, step 3, trim the unnecessary expenses. So when you put this all down on paper or on the computer, you'll be able to see, it's very telling. You'll be able to see things that you didn't know you were spending. You didn't know, oh crap, I have $30 worth of gym membership fees that I don't use ever. You can stop paying those. Don't pay for things you're not using. A lot of subscription services are monthly now. It's great to be able to split up the money, but it's also not noticeable sometimes. So it's good to track these and then be able to cut them if you're not using them, or lower them if I didn't know I was spending $600 a month at restaurants. So that it's very telling to put it all down in one spot and track it.
Yeah, I mean, it definitely can be scary at first. I know it was for me, but that's once you do it and you have that, wow, I'm really spending that much, that's how you work on it and get better. So.
And I've actually been helping a lot of family members and friends recently with getting rid of cable, because they've been looking at how much they're spending on cable, and it's just way too much for something they don't use that much. Everyone has Netflix, whether you have your own password or someone else's. So that's all I watch currently. I don't watch too much TV, but I don't need cable, so I was able to cut that out. I just pay for Netflix, and it's saving me a lot every month. So looking at what you're spending and what you can get rid of is a very helpful tool. And then the last step is to set goals and continue to track the expenses. So when you see yourself spending $600 at a restaurant every month, set a goal. Say, all right, that's way too much for restaurants. I want to get it down all the way to $100. You can set that as a goal, track the expenses through whatever tool you're using, and then make adjustments from there. But doing this will help you see if you're not cash flow positive, meaning you're spending more than you're making, it'll help you get to be positive. And then when you have that leftover money every month, you can either choose to pay down that debt or save more. So it's up to you, but it's helpful, even though it does take a little bit of time.
Absolutely. Yeah, so Jared mentioned he cut out cable. Maybe that made him, an extra $50 net positive each month, and now he can decide, does he have a high interest debt that he needs to pay off with that extra $50? And if not, which is ideal, then he can, put it into a 401k and let that money start growing. So the budgeting is the key to kind of balancing that debt and savings and see where you have extra dollars and what you want to do with them and what's most ideal to do with them. So very helpful, and we're here to help if anyone has questions and ever wants to reach out. So
Yes. And now we'll get into some tools that'll help you with all of this.
So some tools that can help you, and as you can see, we're kind of summarizing each slide and main emphasis bullet points that we just went over, and we have tools for each one. So balancing debt, Jared mentioned the student loan debt and how you can refinance and consolidate where it makes sense. A great place to start to get general ideas is SoFi. They have a lot of different providers, I believe, that you can look at. So that's a good place to start. But then I would also recommend, just going locally too, because as Jared mentioned, he found a great deal at a local bank. So that's stuff you might not see online. So just really be diligent and do your research. And again, we help a lot of people with that. So if you need any assistance, please feel free to reach out to us. Credit bureaus, as Jared mentioned earlier as well. We were talking about how the credit cards can be actually, a beneficial tool for you to build your credit score for things later in life, like homes and cars. So you get ideal interest rates. The credit bureaus are where the banks are actually drawing your credit score from. And the three big ones are TransUnion, Equifax, and Experian. So on these sites, you can actually check your credit score for free. So that's something you're going to want to do, and just, work towards, it's all about goals, setting the credit score goal as well. And you can do that by being responsible with your credit card, not spending out of your means, but just using it to pay it off at the end of every month. So those are some tools to help in the balancing debt department.
And with those three credit bureaus, those are the three main ones. There's plenty of, you see commercials for getting free credit reports. There's usually the ones on TV are legitimate, but they could also ding your credit score. And then there's scams out there as well. So you want to use these three, the main three that the banks are pulling from, what Greg mentioned. And then you can get one free credit score per year from each of them. So you can do it all at once, you can split them up, but that's good to look at too. It's not something you look at every day or every month, but at least once a year you should take a look to see your credit, and then also check if somebody stole your identity, which has been
don't want that.
Yeah, it does
happen. Yeah,
it happens. It's been on the rise. It's something to be aware of.
Absolutely. So those are some valuable resources. As for saving up, which was our second point we touched upon today, your company 401k site. So if you do have that 401k offered to you at work, you most likely have an online access for that. Now, I've seen a lot of these sites. Some are better than others, but most of them are pretty good, and most of them are. Some of them have some great technology and resources for you. And it's just good to keep track of what you're saving. Are you able to increase? A lot of the sites you can increase it yourself on the website, which you want to try to do over time. As you become more cash flow positive with that budget, maybe you get a raise. You want to increase that savings as you increase those numbers. So the company 401k site is great. They have retirement calculators, retirement readiness. Those can be a little scary, especially for us millennials. We're just starting, so we're obviously not retirement ready yet, but something to look at and work towards and improve upon. Secondly, your bank, which is kind of self-explanatory. I'm sure most people look at their online banking that are listening right now. That's where you track your money. That's what it boils down to. But the bank sites as well oftentimes have some good tools and resources to stay organized and educated. Some of them have budgeting tools themselves right within your bank's website. So that's good too. As for budgeting, Jared mentioned both of these tools already, but we'll just touch upon them again. Mint is a great user-friendly app on the phone. If you're not exactly sure how to start with your budgeting process, they kind of walk you through it. Everything's automatic. You can link your credit cards, debit cards, bank accounts. So when you spend out somewhere, it can usually, segment what that purchase was and classify it under food or, mortgage or whatever it may be. And it's awesome. It's a great app. So that's a good one. Every dollar is similar. It's on the phone, easy to use. And then we also mentioned Excel for some people that might, like to do it themselves and see it in front of them, which can actually be very powerful when you're typing in that $300 purchase you made last month yourself on Excel rather than it being automatic. It hits a little harder. So, all these are great tools. We advise that, you just stay on top of this stuff. And a lot of people, they'll start the budgeting, they'll make a Mint account, and then they'll just forget about it. But it's really important that's not going to do it for you. You got to really be on top of it and be interested in it and be interested in yourself and your financial wellness. So, all these are great. We advise that you check them out. Now, if you're looking for more information, we do, for those of you that don't know, we do a webinar every single month, and they're on a varying degrees of financial topics. As Jared mentioned previously, Dave did a webinar last month on buying and selling homes and mortgages. So, if you're in that market right now, definitely check out 12pointswealth.com/webinars, and you can play back all of our webinars that we've had throughout the year, and also register for upcoming ones. So we have one every month, and we're hoping to help you guys out. So social media as well. We have Facebook Live videos that tackle current events. Maybe the market took a big downturn or upturn on the day, and our CEO and co-founder, who I just mentioned, Dave Clayman, he does a daily Facebook Live video. They're great. You can get your daily update, your daily financial update for the day. And that's at facebook.com/12pointswealth. So just some more resources for you guys. Hope you'll, check them out.
And that's our information directly right there. If you have any questions, feel free to reach out. I know
just quickly, we're fellow millennials too. So we're dealing with, obviously you guys heard us talking about it, Jared personally. He just bought a house. I'm dealing with student debt. I just had to get a car loan. So we're dealing with all this stuff too. It's no different for us, and we're happy to help and go through it with you guys.
Exactly. So with that, we are a minute early. So we'll give you guys that minute and let you get back to your days. If you have any questions, give us a call, shoot us an email. Like Greg said, we're here to help.
Absolutely. Thanks for joining us. Have a good day.